Good morning, Noah.
Morning.
Can you please give us a quick summary of your educational background and your experience as a portfolio manager?
Sure. I graduated in the early 90s, 92, from the University of Toronto. I then spent a summer at the London School of Economics studying international portfolio management. From there, I went to a firm called BPI Mutual Funds. BPI was around for a number of years. Eventually, it was acquired by CI Funds in '99. I left in '97 to join the predecessor of this firm, which was Goodman and Company Investment Counsel, Dynamic Mutual Funds. And I've been here since 1997. Also in the mid-1990s, I completed my Chartered Financial Analyst designation as well.
Excellent, thank you. You manage the Dynamic Power Global Growth Fund. Can you tell us a bit about your investment approach and what makes this fund special?
So the Dynamic Power Global Growth Fund we've been running since 2001. So it's nearly 15 years of a track record. It's a global equity fund, and my style is a growth manager. I'm looking for companies that can be significantly larger in terms of revenue and earnings 3 to 5 years from now. And if those companies execute on larger in earnings and revenues, I believe that their stock prices will follow over time. We start initially quantitatively driven. We don't use quant screens to buy stocks. We use quant screens to exclude stocks. And typically we're looking for companies with revenue and earnings growth, high teens or better. From there, the due diligence process begins of searching through those companies, building out models of what they're going to look like in 3 to 5 years, speaking to management teams, and trying to get a sense of what the opportunity in front of the company is. Typically, we own between 20 and 25 names. If you look at the portfolio today, we own just about 25 names in the Global Growth Fund. Only 6 of them are in the index. So we don't look anything like the index or any ETF that's out there today. We're pure stock pickers, and I think especially globally, the biggest opportunities are away from ETFs and index funds.
And how do you see your contribution as being an active portfolio manager versus the index? Because there's a lot of talk these days about ETFs and indexing, and you guys move away from that, especially you.
Well, for me, I think that the biggest opportunity is away from the index. I think that indexing and ETFs are indexing. An index fund is nothing more than a different fund. You know, all it does is it weighs stock by market cap. It's been benefiting from huge flows into the fund. But the more money that goes into the index, the less likely indexing is going to work. When any investment strategy becomes too popular, it fails. We've seen that countless times in the history of the stock markets. So my goal is really, it's not that I'm deliberately going away from the index, but I think that there's such a flow into index funds and ETFs that there's so many opportunities that have been left outside the index funds and ETFs. And they don't have the opportunity to seize they don't have the opportunity to seize those stocks. And so, you know, when we look at it today, our overlap with the index is very limited, and our performance has been very, very strong. So clearly, there are big opportunities to make money outside of the index. It takes a willingness to go outside the index to do that. So in many ways, we complement the index funds because we don't look like them or we're not doing anything like them. In other ways, though, for me, I think that's where active management can offer the biggest opportunity. Especially in global markets, I think indexing is really a U.S. phenomenon. The U.S. market is big, it's broad, it's deep, and so that's where everyone's examples are from. The indexes in the markets are not big, broad, and deep globally. You know, in Canada, indexing has a so-so track record. It's beaten active managers, but any single Canadian bank stock has beaten the index by nearly 4-fold. Royal Bank, Bank of Nova Scotia, which are 3 to 4 times the index return. So who even needed active manager or indexing in Canada? All you needed was one stock. So you see in some of the markets outside the United States that there are more opportunities to add value in only a handful of stocks. And that's why, especially as you think globally, you really need to think less about indexing and more about single stock opportunities.
Noah, can you please share a few stories about your successful stock selection in the last few years?
Well, I'll give you a concrete example of a stock that we found. a number of years ago, before it was a popular investment, and it sort of walks you through our philosophy. We ran screens in the U.S. and globally, and one of the companies that came up on our screens in 2005 was Apple Computer. And at the time, really, Apple came up on our screens. They were demonstrating very strong growth. And we saw that. We didn't just buy it because it was on a screen, though. Then the fundamental work occurred. The question was, what was the growth coming from? And what was the sustainability of growth? And at the time, there was clearly an upgrade cycle going on. There was new translucent computers everyone was getting excited about. And so the initial thought was, well, this is just merely an upgrade cycle, and not sure how long this will last and how sustainable it is. But then once you looked inside the company, it said they had this product called an iPod. And the iPod, which had been selling about 400,000 units a quarter, was an interesting opportunity. The way we sized that market was to look at the Sony Walkman and say, Sony sold 300 million Walkman back in the 1980s. The MP3 player market is probably a 500 million unit. If Apple can get 150 to 200 million units, will that have an impact on the company? And the answer was clearly yes. Not only would it have a big revenue impact, but the margins were better on the iPod than on the computers. So for us, it was saying, here's the opportunity. A lot of people didn't believe that Steve Jobs would do a number of things. One of them was allow the iPod to work on Windows computers, for example. They thought he'd keep it to the Mac. My experience with Steve Jobs actually didn't go all the way back to Apple, but went back to Pixar, which was a very successful investment for us. So I knew the new Steve Jobs, not the one that the media portrayed from the old days. So that story for us was the iPod, which then evolved into a halo effect for Mac computers, and then obviously Apple became one of the most valuable companies in the world. We sort of stepped off of that in 2012 because for us, the key is not only finding those companies, but when we sell as growth managers really is when we feel all the growth is reflected in the stock price. So if we look at the company and say, our best case scenario for what this company looks like in 3 to 5 years, it's already in that stock price. And that's a reason why we would say either we would sell the stock if we owned it, or we would say, it's time to find a different company if we do not own it.
What's the average duration of your investments typically in a company?
It depends on the stock. There are stocks that we've owned in the portfolios for years in the global fund, names like Tencent and stuff. Other ones have come and gone much more quickly. The way I sort of view the portfolio is sort of like a hockey team. We have players on the bench, which are the companies that we're working on, that we have an opportunity on. There's players on the ice, who are the ones in the portfolio today. And then there's the minors and the disabled list. And there's a fluid motion between all those areas. If we continue to see the upside in the stock, in the portfolio, then it stays in there. If the stock is getting tired or it's had a big run, maybe we'll pare that position back a bit. Or if it has an injury or it stumbled, bad quarter, something's wrong with the management team, we'll jettison the stock. We'll watch it for a few quarters to make sure it wasn't a one-off, it was just a one-quarter phenomenon. Typically, we find when they stumble, it persists over time. And so there's fluid motion. I would say when you run 20 to 25 names, we do want to make sure that we don't get overly exposed to one single security. So we do trim around the edges of the overall portfolio.
Any investment teams that you're particularly optimistic about these days?
I do. I think there's a few. I think that if we looked at the positioning of the portfolio today, China is a big position for us in terms of the internet companies there. I think back in 2005, the Globe and Mail said I was one of the few investors in the world that knew anything about Chinese internet companies. I don't think that's true anymore, especially with the IPO of Alibaba. A lot more people know about the Chinese internet companies. I do think, though, that if you look at the Chinese market today, there are more internet users in China than anywhere else in the world. I also believe that that market is going to continue to grow because internet penetration rates are still in the country below 50%. So not only is it the largest market in the world, it's still one of the fastest growing markets in the world. Yet in a whole host of areas, whether you're looking at internet advertising and other things like that, the Chinese market still is a fraction of the global markets. The entire internet advertising market in China last year was the size of Google's revenues. It was the size of, 2/4 of Google's revenues. So when we look at the overall market, we say not only is this the fastest growing market in the world, it's also one that can continue to grow and to double. But the dollars spent in China can also continue to grow and double. And I think that's going to continue to benefit a number of companies, whether it's some of the Chinese technology companies like Tencent, but also one of the big areas in China as well is this massive multiplayer online gaming. It's been around for a very long period of time, but back in 10 years ago when World of Warcraft was a big popular game, you had millions of users on it at a single time in China. Today how it works typically is a company like NetEase will license the game from an Activision, and those, today you can go, there's an event here in Toronto where about 20,000 kids went down to the Air Canada Centre, or maybe it was the Rogers Centre, to watch other kids play video games. So it's an amazing phenomenon. But in China, they'll typically license this from a U.S. company, like a NetEase, and they'll develop local games. And so the gaming business today is larger than the movie business, and we think continues to have a huge amount of opportunity to monetize. We talked to Activision, just in-game purchases. You want another outfit for your character, you want to level up or something like that. That's a multi-billion-dollar industry in-game purchases as well. So Tencent has games, NetEase has games, but we continue to see the big growth in China interactively overall in terms of the internet, in terms of technology. That's been driving the portfolio this year, obviously very strong returns that we've had, especially over the last 6 months or so. Some of those names have really started to take off.
How about e-commerce?
I think e-commerce in China as well is going to be very important. Alibaba is probably the leader right now. I think they have further to go on monetization. But if you look today, as the consumer rises in China, China as a percentage of GDP growth, consumption is around just under 50%. Any developed economy, it's closer to 70 to 75%. So the rise of the consumer in China will continue. Unlike a lot of other countries, though, e-commerce will be a big driver of that. It's hard to find retail space in a lot of places in China. And the vast majority of Chinese will probably be making purchases online. So online has a big opportunity in China overall. That benefits companies like Alibaba for sure, and other ones in China as well. So we continue to think online purchases and online retailing in China has a long way to go as well. The other thing you have to realize is that this is an enormous market, but it's also a market that I don't know if we'll ever shop on Alibaba here in Canada. I don't know if we'll ever book a trip on C-Trip in Canada. I don't even know if we'll ever play a game on Tencent or NetEase or use WeChat. I don't know, but I don't really care, because what I do know is that the Twitter and Facebook and Google won't dominate in China, pretty much by government mandate, that the local market will be for local companies. And the local market is the biggest market in the world. And so there's obviously a natural monopoly created by language and culture, but there's also another monopoly created by government edict. And so this opportunity in this market will be for the Chinese companies alone. And the U.S. companies will not really, haven't been able to, and probably will not be able to compete in the future.
Thank you very much for your time.
Thanks for